Now, I talked to Ed about this last week about that I was thinking that inflation was likely to undershoot most people's kind of very inflationary targets, and that the bond market was telling us something. I always talk about this, the bond market speaks the truth, because the job of the bond market is to closely analyze and forecast where the economy's going. So there's narrative, which is, oh my God, inflation's everywhere. And the bond market was telling us differently, that inflation actually peaked out a while ago. So then suddenly the dollar exploded this week. And it's something I've been talking about for a while, that the dollar got to the bottom of the range. Analysts' forecasts were 100% across the street for the negative dollar. And I've been saying that never works. When they're all one way, it usually goes the other. And at the bottom of the range, it ground out a bottom and then suddenly exploded higher on this confusing narrative. And I think everyone's going to get really confused in this transition, because there's the Fed saying, well, in 2 years' time, we might possibly thinking about maybe raising rates. And at that scenario, suddenly the dollar explodes and the markets get a bit wobbly. And everyone thinks it's because rates are going up. Yeah, but that's not what the bond market's telling you. The bond markets are saying, well, if you do that, dear fellas, you're going to destroy the economy. So therefore, the bond market's saying, actually, we're going to start flattening the curve and we're going to see yields come off. So I want to show some charts just to talk through this narrative a bit further. So I'm going to try sharing the screen now. So here is the chart of the DXY. That's the dollar index. The dollar index had tried to make a new low but failed. And I've been following things like the DMARC indicators, and they were saying the dollar had bottomed when everybody was saying the dollar's about to break lower and it's going to be a catastrophe. I'm like, I'm not sure about this. The dollar's the key macro variable because everything is priced in dollars. So if the dollar goes down, if the dollar goes up, then commodities go down. It's the inverse because of this denominator, which is the US dollar. Don't confuse that with this denominator stuff I've been talking about, the Fed balance sheet. That's a different thing. That's about fiat currency. But just in straightforward terms, when the dollar goes up, commodities start coming down. So the dollar looks like it's forming this inverse head and shoulders. More dramatically, if you want to see it the other way around, here's the euro. It's a huge head and shoulders top. If the euro breaks this kind of 116, 117 level, chances are it goes to 110. What does that mean? That means basically the reflation trade's about to get unwound. A stronger dollar means weaker commodity prices. It's happening in lumber, it's happening in ags, it's not happening in oil. Copper, potentially it's happening. But usually, if the dollar starts moving sharply, commodities come off and the inflation narrative changes. Also, 10-year bond yields, you saw they kind of spiked a while ago, back in March, and they've been coming off since. Now we're starting to get to the key level, which is about 140 on the 10-year. If we break that trend line, then the likelihood is we start going back towards the lows. Now, I think I talked to Ed about this last week, is every single post-recession period since 1962, bond yields have had a sharp squeeze as everybody has tried to price in inflation. And they're always too early. And usually this is just the rebound effects. And then stimulus from whether it's the central bank cutting rates or QE or fiscal stimulus from the government tends to falter. And the central bank, in every circumstance, has come on and cut rates 2 more times at least after the recession finished. And bond yields fall. So I've been waiting for this setup, and it's looking that it's starting to happen. The other thing that most people don't realize is that the dollar tends to go up when bond yields fall, not what people think, which is when bond yields rise. The reason being is the dollar is a safe haven. And if things look like the world is slowing down, then we tend to see money flow into dollars. That increase in the price of the dollar, as I said, lowers inflation. So they work in a feedback loop that drives the dollar higher and drives rates lower. Very typical. See, what's actually going on is the forward-looking indicator, which is, and again, I showed this last week, which is China's credit impulse, which is a good driver of the Chinese business cycle, has been coming off sharply. Chinese economic data has turned negative, And the US business cycle and the world business cycle tends to follow suit soon after. So it's kind of saying, and that's typical again, after a recession, you get the initial sugar rush, and then everything calms down and growth slows back down again. That's usually when the central banks go, oh my God, or the government goes, oh my God, and they start stimulating more. So we've got this slowdown to come in the second half of the year that the markets are not expecting. The year-on-year comparisons for CPI as well will automatically mean CPI comes down from 5% to, let's say, 2.5%. So everything's going to feel like it's less inflationary, and we won't know what the true growth forecast is or where growth is going to lie. That's the story for next year. This year, it's going to be probably oh my God, we've got this wrong, the economy's not so strong, and the government will use that as an opportunity, as all the governments will, to ram through more fiscal. They're just waiting for the opportunity to do it, and that will probably mean more QE. So that is the key part of what's happening right now in market. And so I think the narrative has changed. We're in a transition phase where people think it's reflecting the fact that the Fed are going to raise rates in 2 years' time. That's nonsense. Even I can't remember, one of the Fed governors is on the tape just now saying the Fed always over anticipates at this point in the cycle. The reality is, I think we've got a slowdown coming, and this reflation trade is going to be proven to be well too early. The commodity supercycle may be in play, but that's next year's story. I think this year's story, slow down, more stimulus. So what's interesting, Ash, is yields went up for precisely one day and then collapsed to a new low.
Yeah.
So today and yesterday, yields plummeted. That is not normal behavior here. It's telling us something is different is going on than the prevailing narrative in markets. It tells you that the Fed are not going to raise rates, or if they do, it's going to curtail inflation. But they're only talking about 2 years' time. You know, are they going to start tapering? Probably not. Well, they will start to try to think about tapering, and the rate of change of the Fed balance sheet is slowing down dramatically. But my guess is they'll have to pick it up in due course. And that affects all asset prices. So the stock market is now like, I don't like this change. I don't like this dollar moving fast, because that's the big daddy. And if the big daddy's upset, you know, it spooks everybody else. Volatility is contagious. So if the big daddy, which is the dollar, the denominator of everything, is like screaming high, the equity market's like, whoa, whoa, I don't know what this means. I mean, I already had a call with a friend of mine who runs a giant hedge fund. He's like, oh, we're having to bloody take down risk and hedge because this dollar thing is blowing up all our trades, because everybody's in this reflation bet. That was the value versus growth bet as well. That was basically this point in the cycle, value outperforms. Now, if we go to a looser monetary policy environment again and slower growth, it means tech stocks start to outperform again.